All right. My best Matthew McConaughey. Good morning, Marco. Good morning, traders. Hello. And happy holidays yet again. I realize you guys probably don't see what the shirt is, but it's Mickey. It's my Disney purchase. All right, so I intend to write it off because I've worn it on YouTube too many times to not write it off. All right, good morning. Let's get into it. I'm going to start where everyone expects me to start. Let's talk about CPI. All right, CPI is the latest inflation reading. This is significant, but because this is for November, and we do not have October data, and we will never have October data due to the government shutdown. We're just going missed on that report. So for November, CPI came in at 2.6% versus the expectation of 3%. All right, and the index values, the index doesn't matter because all it really matters is the year-over-year percentage, annualized 2.6 versus 3.0. So inflation comes in softer than expected. All right, and the only reason anyone cares about inflation is not to budget how much they spend or adjust their family budgets or how much things are costing them. It's to guess what the Fed is going to do next. So on that note, U.S. Fed Fund futures raised the odds of a January rate cut to 28.8% from 26.6% after the latest CPI print. It's not a significant increase, but now all of a sudden it's a third. All right, and we don't really know what we were going to get a jobs report as well the first Friday of the next year because the ADP numbers have caught up, and so has the BLS, Bureau of Labor Statistics. So we're going to get more jobs reports. That's going to be helpful to us. But all you got to know is now we're kind of roughly around the third, slightly below the 1/3 probability of getting a rate cut, and that excites everything. All equities, all risk on is risk on right now. It's risking on. And the U.S. dollar is taking a big hit. All right, jobless claims also came in. They were slightly higher than expected. Or actually, sorry, my bad. It was lower than expected, 224,000. Continuous claims and 4-week average was slightly higher than expected. All right, not a big deal. Like, guys, inflation's in here. The market caught a bid. It likes it. We're going to see if this bid could hold because yesterday it was micro movement meeting overall trend structure. Today it's news-driven flow to the upside that's going to meet reality on the opening bell. So we're going to talk about the trading plan more in a second. But first, I want to talk to you because this is going to be the last chance I get to talk to you before this happens about something so big that has such broad market implications that's happening tonight while we're not even going to be looking at the charts that nobody seems to be speaking about out there. Well, I wouldn't say nobody, but very few people are actually realizing the impact this will happen because on the other side of the world, the way the globe spins, it's in Japan. And we say to ourselves, well, who cares what happens in Japan? Something really big is happening in Japan that you should care about, and that is happening tonight. All right, 9:30 p.m. Eastern is 2:30 GMT, but that's Friday for Japan, Friday morning when the market's open. The Bank of Japan is expected to hike, not cut, hike rates by 25 basis points to 0.75%. 86% is priced in by markets. Consensus by economists are 90%. So almost a done deal that they're going to be hiking rates by a quarter point. All right, and it's the first hike since January 2025. So on the opposite side of the world, there's an opposite type of momentum happening. It's not bearishness, it's not dovishness, it's hawkishness. So this is why it's important. If Bank of Japan hikes, all right, the Japanese yen strengthens. And people do not realize the importance of the Japanese yen to global financing and the way the entire world spins around economics, all right? The Japanese yen is single-handedly the most important currency worldwide. I'll tell you why. Because if the Japanese yen strengthens, the carry trade unwinds, which means it leads to margin calls, which means it leads to forced selling in assets that are tangible, like risk assets, stocks, future holdings, Bitcoin. Everything that you're holding in your portfolio could be sold tonight at 9:30 p.m. if people need to shore up some of their margin based on what happens here. All right, the volatility spikes, the yen bids more forced selling and liquidations happen to U.S. equities. All right. Happening right as traders gear up for the holidays in a thin volume environment. The sneaky little report today that could have way more impact than a little CPI print. All right, this is the risk that's associated with the hike. If they just hike 25 basis points to 0.75% in Japan, I think the reaction's muted. I think equities are going to get a little active in the futures market. I think your holdings in your portfolio are going to be frozen out because post-market's going to be closed. It'll be 9:30 p.m. So you're going to just be kind of sitting there wondering what's going to happen. And your only barometer will be the ES futures because they move 23.6. So here's the really, really big thing. And people, I don't know, we don't follow Japan as much, but Japan's been buying ETFs on the open market. Imagine the Federal Reserve buying the VOO ETF or the SPY ETF. That's what Japan's been doing. If they make an announcement that they're selling ETFs starting January, all right, this would signal an accelerated normalization and a lot more hawkishness. That to them is the hawkishness factor, is the ETF selling and unwind. And their balance sheet isn't based on corporate bonds and government bonds like the U.S. Well, the U.S. is mostly government bonds, USTs, the treasury market. But if they start selling ETFs, that's a downward pressure on the stock market automatically. All right. And it takes Bank of Japan as one of the biggest buyers and supporters of Japanese equities off the market. That's a major hawkish catalyst. The percentage of this happening is low. It's 25%. But the U.S. equity impact would be massive if that happened. It would be one of these things that you woke up to in the morning and you're like, what the frick happened? And you find out it's Bank of Japan, and you would be mad at me for not talking about it. So today's morning market update, I'm dedicating to that. All right. Why does it matter? Well, S&P could drop 0.5% to 2.5%. On average, this is kind of the calculated move depending on the severity of hawkishness. If Bank of Japan starts unloading ETFs, it's going to push their stock market down. Last time it dropped 12%. I'll talk about some historical context in a second. Their stock market will go down. The Japanese yen will go through the roof. It'll start forced liquidations on a lot of equities while the market is closed. So people will say, hey, my portfolio is going to get beat up. Smart people, fund managers. What am I going to do? I'm going to short the future, so at least make some money overnight. So by the time I open up to sell my equities, the loss is minimized. So that would put a really big aggressive sell into the ES. If you've ever been wanting to trade in the evening or watch the market in the evening, not necessarily trade it, watch tonight at 9:30 p.m. Eastern. All right. As the Japanese yen carry trade unwinds, you're going to get tech and growth names in the U.S. to be most vulnerable. Your NVIDIAs, your Teslas, your MSTRs, they'll be down 2 to 5% on a hawkish surprise. Easy 2 to 5%. And as the Japanese yen bids and unwinds the carry trade, defensives tend to do good. Think ETFs like XLU, XLV, XLP, they tend to outperform. The August 2024 flash crash was triggered by Bank of Japan. This was a carry trade unwind. So you think, well, this is impossible. Why is no one talking about it? It already happened. And the same playbook could be in the making right now if they are increasingly more hawkish than expected. Now, understand the severity of what this sounds like is less probable, okay? But it's like insurance. You don't buy insurance hoping your car crashes. And I'm not telling you this hoping the market crashes. I'm telling you this so you're just on the lookout and you're cautious. Here's the historical context from August 2024. All right, this would happen. Bank of Japan had unexpected hawkishness. So again, this is an out of nowhere, more restrictive environment for liquidity, and they were extremely hawkish in that scenario. 12% drop in the Nikkei futures in Japan. And so who cares? That's Japan. I'm not out there. I don't have investments in Japan. Oh, but you do. U.S. futures went limit down in August of 2024 on this news. So S&P dropped 3% in hours. VIX spiked to 65, and recovery took 2 weeks. Yes, it was a short-term event. And yes, we're day traders, so it may not impact us as much. Think about a portfolio manager and how he would react to this and what they're feeling going into the last week, the last main trading week of the year. Next week, things are going to be slow. The week after are going to be slow too. So here's the lessons we can learn from this. Bank of Japan's surprise creates disproportionate volatility out there in the market. Given it's a holiday thin week and people are starting to leave for the desk, it might be even exaggerated more so. And CPI wasn't the last thing that people are watching for. If you're a portfolio manager, oh man, Erica just said, let me see. The video is frozen. Hang on. Let me cycle it. What about this? All right. Well, I'm back now. Okay. Maybe if my video froze, that's okay. I'll just flip the thing. Dip buying worked, but in that scenario required a 48-hour patience window. All right. And this is the last event here. It's not CPI. It's the Bank of Japan, where portfolio managers are going to be watching with pins and needles before the year end. And then they're off. Then they're off for the holidays. All right. Because they've had enough. So let's take a look at the markets here together. And good morning, Marco. Mikey, good morning. Well, okay, Mikey, that's a good question. Think about it this way. If the people borrowed the Japanese yen. They borrow yen because it's so cheap to carry. All right. So you're going to pay interest for sure. And the interest has been 0.5%, 0.5%. Let's say the bank lends it to you a little bit higher. They got to make a spread. Let's say you're already getting it at 0.7%. You could take that money from Japan in yen and bring it to the US, slap it in a savings account and earn 4%. All right. Or put it in the market and earn the yield on dividends, earn it on capital appreciation. It's a easy way to finance your portfolio with a cheap cost. You pay the 0.7, you earn the 5%, Bob's your uncle. But now if you're very heavily leveraged and you used all of the money and the moment that the interest rate goes up on the yen and now you owe, 25 basis point more interest rate, well, guess what? Now your profit is reduced, but also you're going to have to spend more cash to pay that interest. You're going to have to sell the investment you had with that money to begin with. You took it at 0.5, you invested it for 5. Now you're going 0.75. You're still getting 5, but you're making less money. And because you're making less money, you have to pay more interest to Japan. You're going to have to deleverage the risk to pay that premium back to them. All right. And that's the carry trade in a nutshell, but it's so impactful for the stock market. All right. So let's look at the chart today here. It's a great question. You're paying attention, Mikey. I love to see that. All right. My eyes are going to be up here a lot. So yesterday's price action, let's start there, because I think when you're starting a day, you should sort of know where you came from. Know yourself, know where you came from. Yesterday, ES opened at 68.63, and I love to tell a story. I love a good story, and telling the story leads up to the trading plan. Very nice. It actually builds your trading plan. If you can tell the story what happened in the last 24 hours, your trading plan's done. So ES opened at 68.63. We got a little bit of a fake bid here, and then we sold off pretty aggressive. We started rotating after that sell-off, but below the opening range, and at around 68.55, we saw a huge iceberg order that didn't hold. Now, iceberg orders is a whole thing. I don't want to get on a tangent, but the iceberg order, the way it traded and the way price went below it, was a sure sign there was more bearish liquidity to come. The sell side, the smart money, the big reload was on the sell. All right, so that pushed price lower. We flipped short in the room because initially we're like, let's see how bullish we could get, but the message was microstructure. Don't take overnight strength and get bamboozled by the fact you're in a bearish structure market. That's exactly what the market wants you to do. Don't take overnight strength and confuse it for new bullishness. You're going to have to get a higher high and a structural change to get new bullishness. Just because you're up a little bit in the European session isn't bullishness. And that's what I was trying to tell the room, especially seeing the bearish order flow. Sure enough, we got prices to go down, mid 40s. These pink lines here are big order flow moments. The downside, heavy selling. We continue to push lower, and we dropped down to 35. Now, 35 was a level that was the prior overnight low. And once we broke that level, we made no hesitation. We continued to go downward, and we just hit all of my levels. We hit the 12. We hit the mid 80s that I had drawn out before, and we actually stopped at the mid 80s, but the damage was done. The prior day session low was 75.5. So we hit 75.5, and what's worse is we closed at 78, only 2.5 points higher after a big giant drop of a day. We opened 68.60, and we traded down to the 75. So it's 60 plus 25 points. It's almost a 90-point day, almost a 100-pointer on the downside. All right, and all we managed to do and muster up the courage to do is to close 2.5 points higher. Very bearish. Okay, overnight, things took a little bit of a turn. Overnight, we got rotational. We did try to move a little bit lower in the session, and we've formed the overnight low at 71.5. Okay, we just took out the U.S. session low overnight, and then the European market open created the distribution of the short positions, the buy stops, and we pushed them up. So we got to CPI. This morning now we're at CPI. We're telling the story. We got the CPI. Market was around 9.25 before the CPI report. This is what the big red line is. When you have a massive report like that, always mark it on your chart. All right, always mark it on your chart, because it's going to be a level you'll see. It'll have influence today. That's the pre-CPI trade. We go up, Mag 7 explodes. Everyone's happy. Twitter's going wild. Equities bid, and here we are. We put the new overnight high at 38.5, and everything is good, right? So here's today's trading plan. This now brings me to the trading plan. Mikey, you are most welcome. You ask all the questions you need to, brother. I'm here for you. And thank you. That was a great question, by the way. I just saw the comment. All right, so here's the trading plan today. We have a new structure, lower low. All right, structurally, yesterday we put in a lower low. And the mistake many traders make is to look at the chart like this and say, where are we going? I don't freaking know. Zoom out a little bit. That's the real answer. All right, let's zoom out a little bit. Is this enough? Yeah, I guess this is enough. Zoom out as much as you can, and then zoom in into price action. Don't go the other way around. Don't zoom in, get knifed up, and zoom out and realize why you lost so much money. Zoom out first and then go deeper. So as you could see here, yesterday's move was very important because we are in a bearish structure, in a bearish trend with lower highs and lower lows. What was different about yesterday was the magnitude of this lower low. Because when you see here, you know, we've had lower lows all December, right? We're pushing lower, we're pushing lower, we're pushing lower. This spill and the new low formation was by far the most amount of move for if you compare low to low. And I do that very often. What is the low to low calculation? Because that tells you the net move. Doesn't matter that it hit a low and rotated up. All that matters is on a net basis, these lows, where are they pushing? And this was a really big new low spread. Okay, really big. So unexpected, because on average it's about 15 to 20 points on the ES. Okay, that's something you can write down in your book. On average, about 15 to 20 pointers on the new lows. Sometimes a little bit less, but it's around that. All right, this low from the 20 down to the 71 was 50 points. So double the average. So this is the question I have. Was this the big distribution, the big liquidation event everybody waited for? Are we on to the new bullish cycle now? We could be, but here's the caveat, and this is a big, big caveat. All right. Despite the bullishness we've seen in European session, despite the bullishness post CPI and the Fed optimism and Fed watch futures going up, that's January's problem. The reality is, so far in December, is that we have to kind of go and hit above 80 and 92 in the 6,800 handle in order for the ES to really terminate the bearish structure. That's where you're going to get comfortable bullishness. All right, we're really far from that. Even though we've rallied 50 points off the low, we got another 50 to go. Look at me, Dr. Seuss over here. All right, so in today's price action, I'm going to clean this chart up after YouTube. I know it looks ridiculously messy, but for example, like that red level can go. I can even clean it up with you, but in the interest of keeping it short, because I got to map out my levels first and I delete all that crap. I just go tools, erase all non-text drawings, all these lines disappear. But what I'm looking for today is 48 to 50 to the 55 area is your first big resistance. If the bulls can't go above that today, we're done. Start selling, because that level was a big order flow level yesterday. All right, if we can get above it, you start to look for some pullbacks, maybe lower for the extension up. But this is what I'm going to tell you. I don't want to get bullish until we get north of 55 or we have information to help us out. This is a news-driven bullish move on Fed expectations that's going to meet trend resistance at the top and a trend that's been intact a long time. So today, rather than getting on the bull train like everybody else, I'm going to watch the bull train for information, watch where it stalls out, and hopefully my first trade will be a high probability short. The thing that terminates that trading plan for me is If right off the open you get huge buying and it never stops, you get big order flow, big aggressive buying, then my plan is invalidated by the smart money, the big boys who trade massive contract sizes. Because compared to them, we're just little retail children, all right? And I'm part of that. I'm a retail child with you, all right? So we got to stick together as retail children. That's the update for you today. I hope you enjoyed it. Also on the options front, there's some gamma positions, 68.37. I should mention that one. That one's very important. 68.37 on the ES. This is basis adjusted for the ES. Is going to be a really big resistance there. Dealers will have to hedge that gamma out by selling futures. And we all actually saw it. We ran into it with full steam ahead from CPI, and we're just stalling out right now. So that's the first level. So 36, 50 to 55. If we could get above the 55, start to get a little more hopeful for bullishness. But it's still a bearish trend. Don't get ahead of yourself and don't get in front of the market, because you're not influencing the market. You're trading it. If you traded 3,000 minis, then you're an influencer. You go do your thing. You're setting the tone for the day. I'm not trading 3,000 minis. If you're trading 3,000 minis, you're sitting at a big desk somewhere, or you're a portfolio manager of, multi-billion-dollar portfolio. So that's it. That's what I got for you guys. Look for this rally to hit some big resistance. Look for the short trade. If flow comes in and just gets super bullish in the opening round, in the opening minutes, and then the follow through of it, then invalidates the plan. I have no problem jumping long, but I don't want to start long because I don't want to be wrong for long. And that's what happens when you start long at the top of a 50-point move already. That's the last half of it has been CPI driven. All right. But since we marked the CPI level, watch that 09 on the ES. If it retests and it holds their support, wouldn't be surprising. That confirms some of the bullishness. I love you guys. Have a great day. I don't know. I'm sorry the camera froze. I tried something new today, a higher quality camera, but maybe it's too high quality and YouTube can't keep up with the ingestion of the data feed. Love you guys. Take care. Have a great day. Tomorrow's the last morning market update of the year, and then I'll see you next year. So let's have a big one. 9:30 p.m. today. Watch out. Big potential for big